A bank lending crisis or credit crunch could be amongst us now and the foreseeable future. The Federal Reserve, in its own words, has made it clear that they're looking out for and expecting the banks to have to tighten lending around the current economic circumstances and the fragility of the banking system currently for banks to try to stabilize themselves and minimize their chances of becoming the next Silicon Valley Bank. In this video, I want to cover why this tightening process, this potential credit crunch, could be devastating for almost everybody in the financial system except the rich. We're going to talk about it in this video. This is JP from Blueprint for Prosperity, helping you to increase your net worth through relationship banking, maximizing your borrowing capacity, proper use of life insurance, and the ownership of real estate. Like the video, subscribe to the channel. I'm uploading content on a daily basis to help you customize your blueprint for prosperity. So since 2020, March 2020 in particular, the financial system has been anything but stable and predictable. And everybody who's not been living under a rock or was born a couple days ago knows what March of 2020 was. The world had to go to a complete halt almost across the board, but particularly economically. And from that point in time, there has been tremendous shifts, ebbs and flows of our monetary policy since that point in time. The response to COVID was to pump money in the system, to provide liquidity and emergency funding for everyday civilians and citizens through stimulus checks, and for businesses of all sizes through PPP loans and i.e. EIDL loans and things of that nature from the SBA and other entities. Basically greasing the wheel and putting liquidity rather into the system. Since that point in time, we saw crazy responses in the asset markets. The stock market took off after a significant plunge when COVID was first introduced to the world. It took a major bounce by the late summer or fall of that same year. The real estate market in the US went absolutely haywire. We saw ridiculous bidding wars, amazing amounts of overpricing, and people paying enormous amounts over asking price for homes, waiving contingencies, waiving inspections, and it drove housing prices up by insane numbers that we haven't seen in this country before in a short span of time. The crypto market went through its changes and the list goes on. As we fast forward to 2022, finally, the chickens came home to roost, if you will. The inflation numbers started to kick in and we started to experience very significant inflation that could not be ignored. The Federal Reserve was pressed about inflation in 2021, at which it responded to inflation not being a thing. Then it graduated to saying inflation was a thing, but was transitory. And the next thing we knew in 2022, spring to be exact, we had rate hikes on the way. So with that being the case, we're here today, about a year into that economic tightening from the Federal Reserve from their original rate hike, at which they've come from almost 0% Fed's fund rate to up to 5% in just a year's time, which is an amazing jump in the short-term interest rates. All of that having been said, it put a tremendous stress on the banking system. And we're talking medium and smaller banks in particular. I'm sure all banks are feeling the effects of this, but particularly medium and smaller banks are in unique positions with their business models, who they're lending to, the assets they hold, with the deposits that they're securing, all being affected by the spike in interest rates. Silicon Valley, First Republic, Signature Bank, Credit Suisse in Europe, several other banks have been an example of the catastrophic response to these higher interest rates domestically in the US and internationally. Now that we know that there's a serious stress in the banking system, and the Federal Reserve has acknowledged this in their recent FOMC meeting, the Federal Reserve is expecting these banks and domestically at home to have to tighten their lending. Why would they do that? Well, in order to stabilize their books, they have to limit the exposure they have in the market. And they have to be careful now, much more careful, who they're lending that money to. So they can't take the same level of risk that they might have taken in previous economic cycles or even just a year or two ago. With that having been said, the gut of this video is to talk about the consequences of this of this tightening, of this lending tightening or credit crunch that we could experience in the banking system. The problem with this situation is banks still need to lend money in order to keep their doors open. So they're going to have to continue to lend. But if they can't lend at the capacity that they once were, or to the audience or the target, the clientele that they once were, then who are they going to lend to? They need surety, they need security, and they need less defaults, less risk of defaults. If that's the case, that forces banks to have to lend to only those who have assets, who are bankable and have great credit. This is by default benefiting the wealthy and the well-off. Why is that? Well, if banks are almost exclusively lending to this group of people, then that automatically obliterates the competitive nature of what's left of our free market in this country for everyday individuals who may not have a lot of money in the bank or be highly bankable, have a lot of assets, or have phenomenal credit to participate in the market and borrow effectively at affordable rates like the wealthy are going to be able to do. And this is a problem because when you think about the real estate market, when you think about businesses, all of these things desperately need access to capital to function. And even though the Federal Reserve is trying to see the hope in this situation by the lending in the lending, limitations or the credit crunch that we are on the cusp of facing, basically doing the same work as their interest rate hikes and pulling liquidity out of the system, which helps to reduce inflation. They're looking at the silver lining that, hey, this could help compress inflation without us even having to continue increasing interest rates, the Fed's fund rate. The side effect of that is many people who are functioning small businesses, small mom and pop real estate investors, even people who are going to be in the credit card market, the primary home mortgage market, could experience higher hurdles to access the capital. And this is going to leave those who already have with most of the liquidity in their hands. So if there's less competition from the mom and pop investors, less competition from the everyday purchasers, less competition from standard and everyday borrowers, this just leaves an even broader marketplace for the wealthy to take off on asset acquisition, on borrowing money still relatively cheap, effectively and fast, and being able to snap up a lot of resources and assets, which that's no shade on the rich. But unfortunately, that leaves 90+% of people in this country participating in the economic market and the investor markets stuck with, no gunpowder. And that's not good. Yes, this could lead to inflation being reduced, but you're going to have a serious, heating up of the gap between the wealthy and the haves and the have-nots. You're going to also reduce economic capacity, which is what's going to reduce inflation, but it's not going to reduce economic capacity for everybody equally. And this is going to be challenging because, again, the wealthy have already accelerated their positions just since 2020. We've seen massive growth in the resources and assets that the wealthy have attained in their net worth. Anybody that's owned assets just in the last 2.5 to 3 years have seen tremendous upside up until late last year or early this year. And some markets are still hot. Those of us who may not be in great financial shape, but have typically been able to access funding through the business system could run into walls, barriers we haven't seen before. So what is my recommendation closing this video out? My recommendation is if you're somebody who does not have a ton of wealth, who's not well known by your bankers, and you have strong banking relationships yet, you don't have prime credit, if you're not in that position already, this needs to be your top agenda going forward. You need to attack your bankability and you need to attack your lendability. You need to be striving for the best credit score you can possibly attain as fast as possible, legitimately, not through these backdoor methods that get marketed out to people, pushed out, confusing people and having people think that they can skirt the banking system or skirt the financial system and get access to cheap capital through all of these little gimmicks and games. You need to legitimately build your credit profile and legitimately build your credit score. You need to stack credit. Anybody who's willing to lend to you on the proper terms, giving you useful financial products, you need to try to attain them. You need to master your banking relationship. This is one of the most painfully underrated portions of our economic system, and a lack of economic and financial education for many everyday Americans. They take their banking relationship for granted. And I've been screaming on this channel. The relationship banking is literally the motor behind wealth building in this country, because banks are at the center of money flowing in the system. So you need to have strong banking relationships, healthy deposits, healthy direct deposits, no negative balances, borrow effectively, know your local bankers, know them, be on a first name basis, sit down with them, talk future plans, do business with them. These are the people that these bankers are familiar with. That's where the trust is going to go, because they can't take the same risk on unknown borrowers. They can't do it anymore. You have to get out of that position and become notable, become respected, responsible, become trustworthy. And you do that through strong financials, good banking habits, good borrowing habits, great credit scores, good deposits, strong financial positioning. Get yourself in order, or you're going to get left behind. I enjoyed bringing you this content. Hope it was valuable for you. I hope it lit a fire under you. I hope it was inspiring and informative, because I'm telling you right now, this credit crunch that the banking system is headed towards, this lending crisis, the Federal Reserve salivating because this is a great opportunity for them to get their goals achieved without having to push any harder. But it's going to make it hella hard on the rest of you who are not in a certain bracket. Prime credit is anything 740, 760 and up. Nowadays, even 780 plus. Good deposits in the banks, typically $10,000 or more. And the list goes on. Consistent direct deposits. Meet these markers the best you can. Put yourself in the best position. Show stability. Become trustworthy. As always, I appreciate y'all tuning in. I want y'all to stay focused. Stay in motion. I'll see y'all soon.